Good afternoon, everyone. Thank you for joining us. My name is Liz Petrelli. I am your annuity marketer here at Underwriters Marketing Service. Here at Underwriters Marketing Service, we are your back office support for life, long-term care, fixed and FIA business. We have been in business for going on 37 years now, and we are constantly striving to provide you, our agents and reps, with education, support for your business, marketing tools to help you to continue to grow and develop. We are very, very excited today about our speaker, but before we get started, a few housekeeping items. This is a webinar for financial professionals, so if you are not one, please disconnect at this time. This webinar is also being recorded, so if you don't wish to be recorded, please discontinue at this time. We will be answering questions at the end of the webinar, so please go use the chat button on the right-hand side, and we'll get to those questions at the end of the segment. So I am happy and proud to introduce our speaker today with Harry Enstell. Harry Enstell is a published author and founder of the Financial Verse organization. The Financial Verse books and content are dedicated to improving America's personal financial literacy. He is an acknowledged senior thought leader in the global financial services business with over 2 decades. Hold on. There we go. Sorry about that. I wanted to have that up while I was reading. He has been a CEO or president of 2 of the nation's largest annuity companies and an active voice in the annuity industry for over 20 years. He has worked in the US and abroad, including Europe, Northern Asia, Africa, New Zealand, and Australia. He is a past director of NAIFA, the Financial Services Council of Australia, and the Insurance Marketplace Standards Association and LIMRA. He has been a governance fellow of the National Association of Corporate Directors. Harry is a nationally known speaker, podcast guest, and author covering annuities, life insurance, and personal finance. Harry, welcome.
Well, Liz, that's great to be here today, and look forward to today's session. So I think next up, you have an announcement.
Yes, I do. So we were lucky enough to get some copies of Harry's book, and we were going to give away 5 of those books randomly to 5 of the people that are on the call today, as long as you stay on the call through the whole thing and you take my call when I call you. So if you're on and you're lucky enough to get one, hopefully I'll get one. Looks good, Harry.
Thank you so much. I appreciate that. All right. So let's go ahead and talk about today's session. I'm going to talk to you today about lifetime spending with annuities. And I think it's going to be a little different. And what I hope to do today for you is to give you 1 or 2 ideas that you can use in your practice to better position annuities as a tool to solve consumer financial problems. And then secondly, what I'm going to do is hopefully lift your level of knowledge about products. I know you, Underwriters Marketing, I've known the team for a long, long time, and I know they deal with very experienced producers, but I think I'm going to help you maybe see things a little differently today. I've been in this business a long time. I've been, as Liz mentioned, the president or CEO of 2 of the large annuity companies. So I've been doing this for a long period of time, and I've actually had a chance to sell annuities all around the world. But what we're going to do today is I'm going to talk to you about lifetime spending with annuities. And my premise is this: a better way of positioning annuities is the fact that you can help consumers look at it and they can use the flow from annuities to fund their spending. And in fact, just in the last couple of days, the organization Personal Capital came out with the results of a survey that they had. And what they said was the following, which was interesting. Over 81% of Americans defined their financial well-being as the ability to spend how they want to. They want to be able to spend how they want to. And I know a lot of times as we sell annuity products, we talk about lifetime, guaranteed lifetime income, protected lifetime income. But today, I think I'm going to turn it around a little bit. We're going to talk about lifetime spending. So with that, if we go to the next slide, Liz, that'd be great. And a couple things, just the typical compliance, the compliance disclaimer. Please, those of you on the line today, follow the compliance requirements of the companies that you represent. Any other relationships you have, be it broker dealer, investment advisory, you must follow their approach. And what I've done in terms of what the Financial Verse has done, the information we've provided today is as complete and accurate as we can make it, but we can't guarantee that we've got everything for you today, but I think you'll see we've done a very reasonable job. And then secondly, the presentation that's here, it'll be recorded, but please, we don't want it to be distributed out to the world without written permission of the Financial Verse. So I think that's important indeed. So let's go ahead over, and Liz, on the next slide, let's talk about the section overview. I'm going to walk through with you the current environment for annuity products, some really interesting developments that will help you in your practice. I'm going to talk to you about senior spending levels, what seniors spend to live, medical cost considerations, long-term care costs and how they affect planning, discuss with you the income replacement ratios and why they're important and what the confusion is relating to them, and then talk to you next about proposed changes to Social Security. Now, Social Security, in my view, the Social Security retirement plan is really the annuity, the inflation or partially inflation adjusted annuity that every consumer owns. They don't realize they own an annuity, but they do. And we'll talk to you about that. I'll also highlight for you some sources where you might be able to learn more about annuity products. And then we'll sum everything up and have some time for questions and answers. So as we go through, so we'll try to be as clear as possible. But again, as Liz indicated, if you have a question, just type it into your to the panel from the GoToWebinar, and I'll try to answer those as I go along. I've got those up in front of me. All right, let's begin to talk about the current environment. Some of this will not be a surprise to you. Maybe some other elements will. Wonderfully, we all know that interest rates remain at record lows. In fact, per the FDIC, 1 to 5 year CD rates are from 14 basis points to 27 basis points. So no one's going to get any money from CD rates at this particular point in time. Secondly, we've seen a trading range with the 10-year Treasury, which is often used to price many of the annuity products that we have out there. And that range has been between 1.2 and 1.75% over the last 180 days. I think today we're around 1.2. At the same time, many of you are dealing with the new DOL fiduciary standard. And then at the same time, we've got some potential changes in that standard that are on the horizon. So we're going to have to be aware of those. And then next up, the NAIC best interest standard, or their modification of Model Reg 275 is starting to be implemented. I think we've got 20 states now that have adopted the new requirements. That's something that you all are dealing with, and if you're not, you probably soon will have the opportunity, the wonderful pleasure to do that. Next point, I think, is a positive one for the industry. Oh, if you could go back on, Liz, 1 second, please. I want to hit this last point real quick. If you take a look, folks, we've got a lot of money sitting in banks right now, earning very little, if any, interest rates. So people are just uncertain with what to do with all their cash. In fact, as of early July, I checked with the Federal Reserve reports, there's over $17 trillion on deposit in commercial banks, $17 trillion. So there's a lot of money waiting for a place to go. So that should bode well for annuity sales as the year goes on. Now, on the next key aspect of the current environment on the next slide is what's happening with the demographics in our country. At this point in time, I guess the first thing I should say is when you take a look at your typical annuity customer, typically it's been the 50-year-old and older who's been the buyer for these products, although recently research is indicating that 45-year-olds, around mid-40s, folks are starting to get interested in having sources of protected lifetime income because they're concerned about whether Social Security is going to pay out when they get there. And there are also more and more folks just don't have a defined benefit plan. They want to create something for themselves. So that 45-year-old threshold is probably where the buyer begins. But if you look at what's happening right now for all of us over the next several years, it's key things going on. 16.5% of the population is now 65 or older. and that's going to grow to 22% by 2050. So prospects in that segment are going to grow. 10,000 people a day are turning age 65, and that's about right. And then also something called Peak 65 is going to happen in 2024. And you're going to see this phrase Peak 65 used more and more. And what it means is 2024 will be the year that the most people turn age 65. Now, by the end of the decade 2030, all baby boomers will be at least 65. So you can see that the demographics are there to help, if you will, potential people who need annuity solutions or who potentially could use them as a tool. That population is going to grow. And two other points I wanted to highlight, and this is the area of my work in the financial verse, but overall, believe it or not, consumers today spend less than 3 minutes a day managing their money. Less than 3 minutes a day. And this is going to impact you because of helping the need to educate consumers about their financial risks and how annuity products position as a tool to help them. And along with that, we've got low levels of financial knowledge, and that is at all levels. And Liz and I, before the call started today, we're talking about this. And right now, we only have 19 states in our country that mandate any sort of personal finance education before an individual graduates high school. Now, there are a number of states that are helping to improve this, but we've only got 19 states that mandate it currently. So what we have are younger people, middle-aged people, and senior folks who don't have a lot of personal finance knowledge, and they need help in terms of understanding what is available. So let's see, if you will, what the world looks like now on our next slide of where sales are. What's selling? What's going on? And this is information as of this past Tuesday with respect to industry sales. And a couple of things I think you'll find interesting. First off, on the upper left-hand corner, total sales, total annuity sales for the second quarter of 2021 came in at $67.9 billion, up 39% over the prior year. The second quarter of 2020. Naturally, the second quarter of 2020 was pretty much the start of the real lockdown issues relating to the pandemic, but 39% increase in individual annuity sales in the quarter. Now, if you move over to the right-hand side, fixed annuity sales were up 13%, and variable annuity sales were up 55%. Now, on the variable side, it was the best quarter variable annuities have had, I think, in more than 6 years. And two aspects that are driving the variable annuity sales. The first is a lot of people were concerned about the administration's proposed retroactive capital gains taxes. And so they decided to use variable annuity products to get their equity market exposure and then tax deferral. And then secondly, the continued growth in registered indexed annuities. And I'll talk to you about that in a second. On the left-hand side of the slide, fixed index sales were up 28% in the quarter. However, only up 2% year to date. So fixed annuity sales have suffered somewhat, have not picked up strength substantially this year. Fixed rate sales just below that were 16.1 billion. And what we're seeing is MYGA products. MYGA products are selling substantially, and fixed rate products. People want safety, but MYGAs are selling very well. And the reason for that, the multi-year guarantee annuities, is they have a significant rate advantage over certificates of deposit, which I showed you on the prior slide. So MYGA sales continue to be very strong. On the right-hand side, immediate and deferred income sales, up 29% year over year, but still not doing very well. About $1.8 billion in the quarter. Typically, income sales and deferred income sales, about $2 billion a quarter is what you see in the industry. But the real winner has been in the bottom right-hand corner, the sale of registered indexed annuities. And remember, registered indexed annuities or buffered annuities, a structured product, people refer to it as different things. These are effectively an indexed annuity where the consumer is able to absorb losses. So instead of having a zero floor, a 0% floor that they would have with a normal fixed indexed annuity product, they might be able to elect 10 or 15% of they'll absorb the first 10 or 15% of the loss on any year. And in exchange for having less of a floor, they get more upside. So the product can offer the consumer more potential return if the equity markets increase in a substantial way. So overall sales are good, but one of the things I like to do is look kind of through the numbers a little bit and see really what the objectives are that consumers are using. And Liz, if you would, on the next slide, this is a slide of information I got from the folks at the Secured Retirement Institute. I attended a presentation, and what this shows you is for the years 2018, 19, and 20, what was the purchase objective from the consumer? Were they buying it for accumulation? Were they buying it for protection, or are they buying it for income? And you can see across the years that accumulation bucket's there, but most people are buying it for protection or income. They're buying an annuity. They're looking to protect their principal because they can't afford to absorb a significant loss, particularly if they've been in the equity markets for years and accumulated their money. And then they're also looking for income. So I think this helps you and helps us understand what's going on with annuity purchases. But overall then, let's talk about consumer realities on the next page. So if you're a consumer today and you're looking at your reality, your situation, first off, and this is a key thing for each of you in the audience, is the fact that there are very few sources of guaranteed lifetime income. They're just not there. Pensions are continuing to decline, and in fact, we're starting to see one of the first generations retiring that has no defined benefit pension coming in at all. And those folks are just not there. So we're starting to see that across the industry. Interest rates continue near zero. That's probably going to be, we don't see the Fed moving dramatically, the Federal Reserve Bank, until at least 2023. And bond yields are at very low levels. We see that every day, see the 10-year being low. So consumers can't find sources of guaranteed lifetime income except for an annuity. So that bodes well for annuity sales. Longevity risk is real and increasing for people. Those of you in the audience know your friends are getting older, they're healthier, they're living longer, they're doing more things, and they're going to need some income, the income to be able to fund their lifestyle, to fund that longer life expectancy, and to cover their spending. Next up, another consumer reality is most people believe, I believe, that taxes are going to go up, and particularly for higher income households. And the reason for that is we're not going to be able as a country to cover all this stimulus money and all the proposed new programs without increases in taxes. So if tax rates go up on both the federal and state level, again, tax deferral becomes powerful, and annuity products have those tax advantages, right? Annuity products have tax deferral. They also have restrictions, and we have to educate consumers on those restrictions, but tax deferral is powerful. Next up also is the fact that, again, equity exposure. A lot of folks have been successful in the market. I think before we went on today, I think all the major averages are at historical highs. Many folks are saying, okay, it's time to take money off the table and let me protect that money so I can have it to fund my later years. So again, annuities fit real well in doing that. And then lastly, which is my central thesis for today, people want to protect their spending peace of mind. It's really important to them to be able to sustain their lifestyle and to be able to spend what they want and do the things that they want to do. And I'm going to give you some insight into that. So I have these light bulbs throughout today's presentation, but first off, what you're seeing overall is a change in planning focus from accumulating assets to distributing assets to fund living expenses. So that's our first light bulb for the day. So let's go ahead and take a look at a more deeper level on what seniors spend. Now, I always, every year, those of you that want to fall asleep at night and have a tough time sleeping, you can always go to the Bureau of Labor Statistics, and they have something called the Consumer Expenditure Survey that you can look at and read. And for 2019, the latest year available, the average household 65 plus spends about $50,000 a year, about $4,185 a month. All right, 50,000 a year, 4185. And I really should put on this slide, and I will need to do it. If you look at the combined Social Security benefit for a couple retiring this year, it's around $3,100. So they got $3,100 in Social Security coming in, 4,200 monthly expenses. Where does the other 1,000 come from? And that's an income challenge they have that to fund their spending. And naturally, annuities over time will do that. But when you drill down and take a look at where households are spending their money, and this slide shows you this: housing, the biggest outlay is housing. Healthcare, you'll notice here, is only $570 a month, about $6,800 a year. And I think that's going to be lower for it's lower for existing retirees than it will be for new retirees. And I'll chat with you about that in a second with some information. So most folks today who are retired spending about $500 per month for Part B, Medicare coverage, Part D, or a Medicare Advantage plan, and then any out-of-pocket costs that they've got to fund. And by the way, that healthcare outlay does not cover long-term care, which I'll talk about in a second. So when you see it, and also here on this breakdown, entertainment, they're spending about $2,400 a year. So when you start drilling down on these monthly costs, what you're going to find out, it doesn't include the big trip for the family, the cruise, the once-in-a-lifetime trip to Italy. It doesn't include any sort of major healthcare issue that comes up within the household. Doesn't include having to pay for long-term care expenses. Doesn't include for having to potentially contribute to the cost of grandchildren or any help that that household may provide to their adult children. But overall, when as a basis for conversation, about $50,000 a year, $4,200 a month. Now, a couple things on the next slide I just want to highlight for you. Again, I look at those as being the essential or the essential living expenses, or the non-discretionary living expenses for households. And it doesn't include the discretionary amounts. It doesn't include the travel cost. It doesn't include supporting family members, long-term care, a new roof, the new roof that comes along, or the household repairs, or the new HVAC system, nor does it include the cost of leaving a legacy. So what we're seeing overall is the cost of living continues to grow, and I'm not discussing inflation today in the commentary, and we need really to save more for discretionary costs. And consumers are going to have to find ways to save more to get more of an income that they're going to need to pay for their spending costs. Now, I told you before that I thought that healthcare costs going forward were going to be higher. So let's take a look at that. And that's really part of medical cost considerations. And when I always looked at this, I go to the Fidelity, comes up with their annual retiree healthcare cost estimate that they publish. And it's really effective. If you haven't had a chance, you should take a look at it. It's like a page and a half, but they publish it every year. And what they say right now is the average couple retiring in 2021 is going to need to have about $300,000 of money set aside to cover their healthcare expenses in retirement. Now, before we took a look at the Bureau of Labor Statistics numbers, it was a lot less. But so basically, new retirees are looking at about $15,000 a year, or $1,250 a month, double, more than double what the Bureau of Labor Statistics is saying. So funding healthcare costs is real important. And as you all know, because I know you deal with customers on a day-to-day basis, clients on a day-to-day basis, the cost of healthcare around the country really vary based on where you live, because some areas of the country are a lot higher, particularly in the Northeast. The health of your family history. Did you win the genetic jackpot, and do you have the ability to live quite longer without having major health issues, or are you from a family that doesn't live quite as long? And so these are all key issues. But this healthcare number is not going to go away, folks. It's there. And I think one of the things that's interesting to me, and I know many of you know this, Social Security was designed to provide the average worker with 40% of their pre-retirement earnings as a benefit. That's the way Social Security is designed for the average worker. But what's happening is that we're going to see medical costs, in particular Medicare costs, increasing with increasing Part B and increasing overall medical costs. It's really going to impact those people. And I'll talk more to you about that in a minute. So let's go from medical costs to what I call the elephant in the room, which is on the next slide, long-term care costs. Now, this information that I'm providing comes from Genworth's 2020 Cost of Care Survey. They haven't quite published the current year one yet, but Genworth's been doing this for about over 15 years. But when you look at this, long-term care costs are real. And we're seeing that, and you see more and more information in the industry that 70% of people, a couple age 65, 70% probability they're going to have a long-term care event of some sort. And these are expensive. And any of you who have had a situation where you have had to care for a parent or find a long-term care facility for a parent, I've had to do that, you know it's really expensive. And then the difficult thing in our society today is that most people believe long-term care costs are covered by Medicare. And we know that they're not. We know that there's a skilled nursing benefit that is provided, I think 100 days within Medicare for folks that need that post a surgery or post an operation. But when you look at it, most people believe those costs are covered by Medicare, and we know that they're not. So they've got to have some long-term care protection. And to me, it's the planning wild card. My idea here, it's the planning wild card, and finding some way to do it either through potentially buying fully underwritten LTC coverage if you can get through underwriting, or an annuity product with an LTC benefit, or a life insurance product with some sort of long-term care benefit. Really important to find some coverage. But you can see the cost here. They range in the upper left-hand corner from just having someone come to your home and help out, about $54,000 a year, to over $105,000 for a private room in a nursing home. So that's substantial. And to me, it's the wild card, and we need to do more here. And people have to be aware that they have to have some protection. So I think some of the products that are out in the industry that have what I'll call combined risk coverage, be they annuities or life insurance, are real important for people, in addition to looking at some form of pure long-term care coverage. Now, a lot of times in our next slide, we get into the conversation, people get into the conversation. I got one, I'm sorry, do it right there. Thank you so much, Liz. On the subject of income replacement ratios. So when you're taking a look at funding people's spending, people always ask you, well, how much of my income should I replace? What do I need to do to make myself comfortable for retirement? And Fidelity, again, Fidelity has some rules of thumb that they publish that are really excellent, but this is a chart that they show that income replacement ratios really are very personal. And they're a function of what your level of income is, with lower income households needing to replace a higher percentage of their income than higher income households. And so this is, again, another rule of thumb, helping people look at what they do. Naturally, I think the best way to look at it is to have someone really look at their spending and see what their spending is going to be pre-retirement and post-retirement, so they have a better understanding of the income level that they need, the cash they need to have coming in to fund their spending. And where are they going to get that? Are they going to get it through Social Security, or can they get it from other investments, or can they get it from an annuity product? And the nice thing about annuity is it comes in every month. It's lifetime income. It's protected. They can't run out. And to be able to use an annuity to fund that essential spending, to me, is very important. Now, the next area that I know we all get tons of questions relating to Social Security and what's happening. So on the next slide, if you take a look at what's going to happen in Washington, in my view, and this will affect all of us in the industry and those of you that have practices day to day, what's going to happen here is you've got a lot of proposed changes that are going to come up for Social Security. And in particular, one of the areas I think is going to highlight this is, I believe everyone's aware, we're probably looking at one of the highest inflation adjustments for Social Security benefits that's going to happen for 2022. I've seen numbers from 4.5% up to 6% of an inflation change. That type of increase in benefits for the number of people receiving Social Security benefits is going to put more pressure on the Social Security system. And remember, Social Security is the inflation adjusted annuity that if you qualify for it, Americans own annuities. They don't realize they do, but they own an annuity with their Social Security plan. But here are some of the things I think that are going to be looked at that you ought to pay attention to and working with your clients. First, you're likely to see some sort of increase in the tax rate. Secondly, they're going to increase the limit that on which Social Security is collected, if you will. There are also some thoughts that it will move to other sources of income, such as unearned sources of income, interest and dividends, that people will have to pay Social Security on. Moving the full retirement age, I think is, again, the U.S. has done that, and we're in that process now. I think we're full retirement age is over 66 years and 2 months, I believe, currently, and I know that increases over time. But some people are saying they should move it up to age 72. And with lengthening life expectancies, it makes a sense. That'll have a huge impact on people's planning for retirement. Next up is the formula for changing the formula for the inflation-based cost of living adjustments. There's been a huge debate going on that the inflation adjustment that's applied to Social Security doesn't reflect the cost that seniors incur. It doesn't affect that, and it doesn't reflect that properly, and that inflation formula needs to change, because in reality, senior costs, in particular healthcare, are going up far higher than what the inflation adjustments have been for Social Security benefits. So we'll have to see what's going to go on there. And then lastly, I think the one that's real important, and I think just keep your eyes out for this one. I think that they're going to need to take a hard look at the benefits formula for low income earners, people that get a very low Social Security benefit. And just before today's session, I did a little research, and 21% of married couples and 45% of singles, Social Security is 90% of their income, their retirement income, 90%. So 21% of married couples, 45% of singles. And if you salami slice that a little differently, 50% of married couples and 70% of singles receive 50% or more of their income from Social Security. And in fact, you're starting to see articles in the major publications nationally. How do you live on just your Social Security income? And we're going to see a variety of things there. So I think there's going to be a lot of pressure on Congress to increase the minimum benefit for those people that have not earned a lot during their lives, and also don't have a lot of retirement savings. So that, in addition, is going to put a lot of pressure on the Social Security Retirement Fund, the trust fund, and funding needs, and so on. So I expect that this debate is going to hit over the next few years, and we're all going to have to pay attention to it, because for so many people, Social Security obviously is a key element of retirement income planning and part of spending planning. What am I going to get for Social Security to support my lifestyle? Now, if you're looking for sources, on my next slide, sources to get information, just let me highlight a few for you. More and more organizations are providing information you can use with consumers, or information that will help educate you to improve your knowledge about annuities. The National Association for Fixed Annuities is one. Secondly, the Alliance for Lifetime Income. And if you haven't spent any time on their website or seeing their materials, they really have some great stuff to use. So Alliance for Lifetime Income, and there's good information there for you. They've even got one of the things I've just written about in one of my blog posts was their calculator, which helps people look at their sources of retirement income to see how protected they are when they retire. So it's significant there. Life Happens has wonderful materials on it and very good stuff to help you with your customers for both spending needs, life insurance, and helping people just plan. Of course, the Insured Retirement Institute. And lastly, the Federation of Americans for Consumer Choice, I understand, is going to be bringing out consumer materials also. So those are sources. I refer to them all the time to get information, ideas about writing various posts and helping people understand what's going on with retirement income planning, and in particular, planning for spending. Now, if you want to, one of the things that I've done on the next slide is I've got a series of books, but I've written a book called Today's Annuity Products, A Tool to Create Protected Lifetime Income. It's available in print and ebook. It's there for you to take a look at. And what I've tried to do is take over 25 years of experience in the annuity business, condensed it to 140 pages. It's a great reference for financial professionals, but it's also something you can use with clients. You can just dog ear a couple of pages, have them read it, and I go through everything from the history of annuities to how to look at setting up what the considerations you should have in looking at your retirement income, and how you should be planning for that phase of your life. So that book's available, and I have other books too. Now, if you want to find out more about what I do, and I have on my next slide, you can go to financialverse.com. I have a series of books on different topics, basic financial financial planning, financial management. I have a book on today's life insurance, today's annuities. I have a book on saving money. I have a new book coming out in September, Good Money Habits in 17 Minutes a Day. And I've been, over the last couple of years, appearing on national podcasts. I have a monthly byline that you can read in Think Advisor about various aspects of our industry and the products you sell and the industry that we're dealing with. And that goes out to about 700,000 people every month. So if you get a chance, take a look at it. So with that, let me summarize our session for you today. First off, annuities are a great tool for income planning. There's no doubt about it. I think they have more value in 2021 than we've seen in years and years and years. In my view, income planning is spending planning for most people. As that personal capital study indicates, 81% of people believe that financial wellness ties to their ability to spend on what they want to spend. And I think that's true. Funding senior spending to maintain lifestyles is what we can focus on. We can help people tremendously with these products. Medical and long-term care costs are huge. I know many of you in the audience are in the long-term care business, and that is, to me, that's one of the areas we can help people, in addition to the annuity side and helping generate that protected lifetime income to fund spending. Long-term care is a huge need that people have. And working with folks, income replacement ratios vary. And again, it's getting to know your client, what their needs are, what their responsibilities are in their household, what they're funding, what they're not funding. And realistically, for me, you really do need to plan ahead for Social Security changes. In my view, when you look at everything in a total picture, with returns lower than where they have been, consumers are going to need to save more and more of their income, and they're going to have to find products and solutions that they can turn the savings into cash flow, positive, cash flow for them to fund their needs. So with that really covers all of my comments for today. And Liz, if we have any questions, I'd be pleased to answer them.
Oh, thank you, Harry. That was great. Let me look. I've not been playing with this, so I could concentrate on the topic. Hold on 1 second. Okay. Okay, Richard, I think we addressed that with the one of the questions was how he could get the book if he wanted to purchase it, and we did cover that. And of course, Richard, I will give you a call afterwards. And we will be sending out a copy of the webinar to the people that were on today. So some people want to go over it again. So yes, we will be sending them out.
Yeah, and one of the things too, Liz, I think for those of you, and we have a nice attendance today, and you people have stayed with us, thank you so much. But one of the things too is, I think one of the issues in our industry today is that we've got a real great time to position annuity products. But I think one of the things that we have to do is our knowledge of how to apply these products and their intrinsic value and how to use them needs to improve. And we're selling an insurance product. Annuities are an insurance product, and I think we need to make sure people understand that. So many times people just say, oh, it's an investment, and they're not. They're an insurance product. They're backed up by solvency, the solvency requirements, regulation in a major way. So I think anything that anyone in the audience can do to continue to improve your knowledge of annuity products. So I kind of relate it, and I know there's another individual in the industry gave me this analogy, but do you improve your swing, or do you get new clubs? And in the industry, the new clubs would be all the new products that are coming out. But in many ways, the swing, or your comprehensive knowledge of how to use and position annuity products, is something you need to spend time on, particularly at this next several years when we have such a demographic sweet spot with so many people turning age 65.
It's true. I just have another question. It's do you have any tips on how to transition from annuity sales, from insurance sales, just regular life insurance products, or even P&C? Some people just mindset is everything about what they think about insurance and annuities. So is there any tips on how to transition from one to the other of you?
Well, I think it's a matter of focus and knowing your client. I think what I've found over the years is that many folks have been in the life insurance, and I'll give you some practical examples from my experience. There have been people who've been in the life insurance business for years, and they've built up a book of business, and then they've gotten in the annuity business when many of the beneficiaries have received death benefits, and they had a way to help them put some of that money away for the longer term. So finding ways to take the cash in certain of the older in cash value, permanent life insurance, and then creating a lifetime income. So maybe some of the old life products were not structured as easily to do that. So coming up with annuity products to position there makes a lot of sense. I think with respect to property and casualty agents, usually the easiest thing for them to do is to move from property casualty to life. And the reason being, they typically know the households they're serving, and it's easy to position a life insurance product, be it term or permanent, for the people that they're providing general insurance products for. That's a nice way to move over. And then the third tier would be getting into retirement planning and providing a variety of different solutions for those people to meet retirement planning needs. So for the PNC agent, Liz, I've typically seen the migration from pure PNC coverage to term to permanent insurance, and then on to annuities. That's typically the migration that I've seen over the years.
That's good. Good answer. Good answer. We do get a lot of that. We do get. I get it a lot. I'm a life agent. I strictly do PNC. So those are good tips. A client that clients with CDs lean on the FDIC. How do you combat that?
Well, I think I think there's a couple different ways. It depends on the state that you're in, whether or not you have a gag order or not, with respect to your ability to talk about the guarantee funds that exist. So typically when you're dealing with solvency, you need to deal with the fact that there's state regulation. The life insurance company that you're selling the product for is the financial strength of that company is the primary source of solvency behind that product. And then in states where you can mention, I believe you should mention the guarantee fund availability in that state. Let the consumer understand what they need to. I talk about this in my book. They need to understand that. So really, we've got for any product sold in our industry, we've got the financial strength of the individual company, which is subject to state regulation. There are publicly available financial strength ratings available from the rating services, and then the backup is the guarantee funds. And then lastly, the thing I talk about is the fact that there have been very few, if any, major annuity insolvencies. I mean, much less than what you've seen on the bond side by buying bonds. So we've had very few incidents where people have lost any sort of money in an annuity product.
Yes, because of that particular reason. Yes. Yeah, that's very true. I've been in the industry and I've seen many bonds go down. Haven't yet to hear of an insurance company or an annuity company. So that is on your side. And we do have a list in the office of those guaranteed numbers. Okay, so anybody wants to get that. I think that pretty much wraps it up. Okay, if anybody else has any questions, they can contact me directly, and I will be reaching out to them about your book. It's very exciting. Somebody's going to be lucky enough to get it today. Do you have any thoughts, last minute things?
No, it's been my pleasure to be with everyone today, and I would just say continue to learn about these products. The more you learn, I think you're going to find more ways to use them as a tool to help consumers. And again, in my work, I don't promote any particular company or any particular product. I just talk about the product class and how to best use it to help consumers address their financial challenges. And I think it's an under your solution. I think the annuities have gotten a bad rap inappropriately, and I write about that. And I think there's much more there. And this is a solid tool to help people solve their financial challenges, particularly in today's environment.
It's true. And a lot of people are saying the great call and thank you. And we appreciate that. That will conclude the call. Again, if anybody has any questions, we appreciate your time. Thank you for joining us. And again, I look forward to talking to some of you after the call. Thank you.